The ability to identify liquidity and an understanding of how to use it in your trading is incredibly valuable. When you can identify where liquidity sits in a market, you basically understand the magnet areas that price is going to be drawn towards, which means you can take great trades with clear targets, you can identify reversal points, and most importantly, you can avoid taking a lot of losses that you'd usually get caught up in if you didn't understand liquidity. So in this class, I'm going to run you through the 3 forms of liquidity that you need to understand. I'm going to break down what liquidity is, and by the end of this lesson, you will be able to trade liquidity at a very high level. So without further ado, let's get into it. The first thing you need to understand is what liquidity actually is. And in its simplest form, liquidity refers to orders or money. Markets move based on the flow of orders. So when there's more buying than selling, the markets go up. When there's more selling than buying, the markets go down. And in order for significant buying or selling moves to happen, the market needs to come into an area with a significant number of orders. Markets will trade freely through ranges because no one is buying or selling mid-range, or if they are, it's happening in very small numbers. But when we sweep swing lows and swing highs, you will begin to see the market forming significant reversals, like this down here and this up here. The reason this happens is that above swing highs and below swing lows, we have a lot of liquidity or orders. Anyone selling from here is likely to have stop losses over the swing high. They may also be taking profits down here. Anyone who bought down here will have stop losses here and will likely be taking profits here. So, when the market reaches these areas of take profits, stop losses, sell stops, or buy stops for the upside, there is a whole load of orders there for the market to react to. And this is what actually causes these reversals and reactions to occur in the market. So, liquidity in the context of a market is simply orders at highs and lows and around different ranges that the market comes into and then reacts from. And as I said before, there are 3 ways that we can identify liquidity clearly so that we can start to use it to our advantage without loads of confusion. And these 3 forms of liquidity are number 1, equal high and equal low liquidity. I pair these together because they're practically the same. Trend liquidity and range liquidity. Now, the most common forms of liquidity that you will see and the easiest to actually identify and trade are equal high and equal low liquidity. So for this class, I want you to put your focus on these 2 primarily, and then obviously take in the information I give you on these ones, but this will be the core of your liquidity trading. So as I said before, markets react to orders. So our goal when identifying liquidity is just to determine where the majority of the orders are going to be placed. Now, in the context of equal high or equal low liquidity, we are essentially looking at resistance or support, because we have either equal highs, which is a resistance level, or equal lows, which is a support level. And basic trading education, which many people still subscribe to, suggests that when you have a resistance, you put a stop loss above the high, so that we know there's going to be a lot of stop losses above equal high levels. Also, you put a stop loss below support if you buy support, which means there's going to be a lot of liquidity beneath equal lows and above equal highs. Now, we also have additional forms of liquidity. We may have traders looking to buy breakouts if the market was to push above a level, which means we'll have an extra layer of liquidity here in the form of buy stops for breakout traders who are expecting to buy if the market breaks out. The same goes for support floors or equal low liquidity. We will have sell stops here from traders looking to sell once the market breaks these equal lows. So what the support or resistance actually does here is formulate a lot of liquidity or orders above or below the level, which means we can use equal lows or equal highs for 2 different things. Number 1, we can use them as solid targets. If we found a buying opportunity in the market here, we could use the equal highs as a target because we know the market is very likely to trade back towards these equal highs and trade through into the liquidity. The same is true for the sell side. If we have a pool of liquidity down here, it's likely the market will trade into it. So if we use this area for a target for sells, that would be a high probability target with a pretty high likelihood of being filled. But the more interesting thing about liquidity is not just using it for targets, but actually the consideration of entries. Now, when we see equal high liquidity, for example, we know this is a resistance. So a lot of traders will be looking to sell here. Now, the first thing you should do is not join them. Don't join traders in selling equal highs. If you see equal highs in a market, the last thing you want to do is try and sell it because it's likely the market's going to push through to react to the liquidity instead. Now, this is where the term stop loss hunts comes from, because sellers sell at resistance, they have stop losses above, and the market seemingly hunts their stop loss by trading through that level, and then it moves in the right direction without the trader who sold resistance because they've now been stopped out. All that is the market reacting to the orders. We need a large amount of transactions in order to get significant reversals. We know there's a huge amount of transactions waiting to be taken up here. All of these sellers will have to buy back contracts for a loss, which provides a lot of buy liquidity that someone can then sell to. So if you had a massive amount of money that you wanted to get into a position and you couldn't get it in just at one set level without moving the market, instead what you can do is wait for the market to trade into an area of liquidity. And when all of these sellers have to buy back, you can jump on the other side of their trade and sell back to them. So this is where the context of institutional versus retail traders comes in. Retail traders, everyday traders like me and you, we only make up around 5% of trading volume. The other 95% is from institutional trading participants with huge sums of money to trade with. And they can't always get into a trade straight away, so they need to reach for areas of liquidity in order to get into positions. That is why, once the liquidity is filled, we get these more significant movements, because it's a large influx of money into the market, either on the sell or the buy side. So how can you use this to your advantage then? Well, first of all, don't sell resistance, because if you do, you're likely to be stopped out on a stop hunt before the market moves in the right direction. But second of all, we can actually use this sweep of liquidity, as we would call it, to get into positions. And the same goes for equal lows. We can use them as targets, but more importantly, we can, number one, avoid buying a support floor because we know there's a lot of liquidity below. And number two, we can actually use the sweep of the liquidity and the sweep of the support floor to get ourselves into positions. So equal high and equal low liquidity is good for targets, getting into positions, and avoiding silly losses. Now let's go over to AUD/USD, and I'll show you a recent example that brings equal high and equal low liquidity into the picture. When you look at this chart, what do you see? The first thing that I see from a liquidity perspective is this collection of equal lows. So we have an area here which acts as an obvious support where the market is trading into this level and pushing away multiple times. This formulates equal lows. Now, if we know that there are buyers buying this support floor, we also then know there's going to be stop losses or orders and potentially even sell stops for breakout traders sitting below. So below this equal low level becomes an area of liquidity. Now, how do we use this to our advantage? Well, as we just said, number one, we avoid buying once again when the market comes down to this level, and instead we wait for a sweep of this level where we could then expect the market to start pushing up because we will react to the orders and transactions that are waiting under this level. Now we know because there's not going to be a lot of orders mid-range because most people are buying and selling or looking for breakout positions from the swing highs and swing lows in the market, there's not going to be much resistance here in the way of buying. So, number one, we could potentially, if we found a short opportunity, use these equal lows and use this support floor as a target for any short positions. And then, once the market reaches this area, we can anticipate a reversal could likely be underway because we will have swept an area of liquidity and the market could then react to those transactions and start moving in the other direction. Now, there's one more thing that you should take notice of on this chart. And don't worry, when you go through the charts, you will start to build experience in identifying equal highs and equal lows. It's very simple. You are literally looking for an area with multiple highs or lows at the same level. Now, what we can also see then is just up here, we have an area of equal highs. So we have 1, 2, 3, 4 perfect touches of a resistance level. Then we have 5, 6, 7, so 3 more additional relative equal highs. Now, these are not a perfect retest, but they do also add to the fact that the liquidity is situated above this level. Anyone selling at this point is going to have stops over the highs. Anyone selling at these levels is going to have stops over the resistance level. So now we have 2 areas of liquidity. We have an area of liquidity just below in the form of those equal lows and all of the orders that will be waiting below. And then above, we have more equal high liquidity this time, where we know there's going to be orders, stop losses, buy stops waiting above. So now we've essentially formed a range with liquidity below and liquidity above. And let's go step by step through the process of how you would look to trade this. So first of all, if you had a selling opportunity, using the equal lows as a target would be solid. And as you will see, the market runs through quite nicely, trades into that level, but does not react from the equal lows. Instead, it pushes through to the liquidity. Now you'll see, once those orders have been retested, the market shifts. We get this new push of strength because there's been a whole lot of take profits, stop losses, and sell stops executed at this level, which has kind of shifted the market. No transactions taking place throughout this range here, major transactions taking place down here, which gives the market a new direction. So how can we use this now? Well, we've seen the market start to shift after trading into that area of equal lows. So we swept the lows and now we've had a big push in momentum, indicating that we may be getting a change in the trend. So what we could do is look for buying opportunities to follow this new sense of direction and the new momentum that we're seeing in the market. So if we wanted to, we could take a trade. And what could we do here? Well, as we know, liquidity, equal highs in this format, is going to act as a pretty solid target. So we could use the equal highs for a target, and we would look to actually trade up from this sweep of liquidity into a new sweep of liquidity. So equal highs and equal lows are good for reaction points and reversals, and also for targets for positions. So let's see how this trade plays out. Now you can see we traded in, retested, started pushing up from this demand zone, and the market will make its way upwards towards this equal high liquidity. Now we do start to get a slight reaction at this level. And why does this occur? Because once again, new transactions have been filled as we traded above this obvious resistance level. So because we know there's a mass of orders up here, and because we know there's not going to be a significant amount of orders within this range, the market was able to freely move through the range, and only when it reacted to new orders did we start to get a slowdown and potential reversal in price. So that's equal high and equal low liquidity. Let's move on to trend liquidity. With trend liquidity, the concept stands true. Pretty much what we're looking for in any format of liquidity, including trend liquidity, is just an area where we know there's going to be a lot of orders. And the best way to identify those is to consider the most common trading concepts used by retail traders today, such as support and resistance and trend lines, because we know that these are going to have a lot of sell stops, buy stops, stop losses all around them. So the traditional way to trade a trend line is to wait for a retest and then sell, or wait for a break in the trend and then actually look for a retest to buy from. Now, the reason that traders subscribe to this idea and this methodology is because they believe that a trend line forms a change in the trend. However, when we look deeper into the price action, so the actual movements of the market price, we will see that this is not 100% true. Now, you can see we had a little change in trending structure at this level, bringing this to be our high and this to be a lower low. Then we pulled back up and we formed a lower high. Then we came back down and now we formed a lower low. So the trending structure in reality looks like this. Now that would mean, unless we were able to break above this high here, the trend wouldn't shift and we would remain bearish, regardless of whether or not we swept the trend line. So a trend line break doesn't actually mean much in the way of a trend reversal, because until we break this high, there hasn't actually been a change in the real trend. So with that in mind, what we can do is look to follow the trend, and then anything that happens regarding the trend line between where we are now and an actual break of structure simply just becomes context for liquidity. So what do we know then? Well, we're going to have sellers at this level. That is layer one of liquidity, because we know any sellers there are going to have stop losses over the trend line. Now, we also know there's going to be breakout traders, so people looking for the push up like this. That's a second layer of liquidity, because we know there's going to be buy stop orders waiting here. And the third layer of liquidity in the context of a trend line will be from manual execution buyers who are looking for a break retest of the trend line. So we also know once we break out, there's going to be more buying here, buy limits. So the area above the trend line now becomes a pool of liquidity, essentially, but it doesn't actually indicate any changes in the trend. So what's likely to happen, and what you're going to see happen a lot, is rather than actually conforming to the trend line, the market will push the trend line, sweep the liquidity, and then start a movement back to the downside, liquidating once again all of the buyers who buy after the breakout. So the sellers looking to sell the retest lose, and the buyers looking to buy the breakout are also going to lose. So how can we use this to our advantage then? Number one, don't trust trend lines. Make sure you're looking at the real price action, such as the highs and lows in the real price numbers. I've showed you now that a trend line doesn't actually indicate the trend at all, and all it does is formulate some obvious liquidity around the level that will essentially work against you and trap you into losing positions. So to actually trade trend lines and trend liquidity, we need to consider the structure. As we've said, we already looked at the structure, and we know that unless this high breaks, the trend is not reversing. Well, we can also see there's a supply zone here. And if you don't understand supply zones, I got a video on it. There'll be a card somewhere in the top of the video now to take you to that. But we have trending structure and we have a supply zone, which just for the record is an area we would look for bearish reversals. Now, by looking at this structural picture, if we were to remove the trend line for a moment, we can quite clearly see the market's downtrending and there's a high probability reversal point. So without the trend line in picture, it's a pretty obvious place to sell. Now, bringing the trend line back into it, we can also consider all of this liquidity, which is buy liquidity. So sellers will be stopped out and have to buy back contracts at a loss. Buy stop and buy limit traders will be buying in, providing even more buy liquidity. And what is the opposite to buy? Well, it's sell, which means if there's a huge amount of buying taking place in this level, if an institutional trader or multiple institutional participants want to get into big sells, they have the liquidity or the conflicting orders to actually get into that position, which means rather than getting a clean retest, we're likely to sweep for liquidity. And rather than getting a clean retest and push away on the other side, we're likely to just sink straight back down. We have bearish structure, we have a high probability reversal point, and we have all of this liquidity that institutional participants can take advantage of to get into trades conflicting to what retail traders are looking at. So now let's just watch how the market plays out. And as you will see, rather than reacting well to either side of this, we just swept out, stopped out all the sellers, traded into the meaningful area for reversals, and then sold back down, stopping out all the buyers. So if you were to trade a trend line in a traditional sense, you would get chewed up and spat out by the market here. But if instead you considered this in the context of liquidity and remembered all the orders that are situated around it and what that may mean for the market, then you would be able to take advantage of this trade by selling from the high interest supply area above the trend line, disregarding the actual trend line for trading opportunities and instead viewing it through the lens of liquidity. Now, trend liquidity can also be useful on the context of targets as well. So it's not just for entries, we can also use it to add confidence to targets for positions. In the context of using trend liquidity for targets, it's not something that we're going to be using on its own, but it can definitely add extra confidence and clarity to where the market might go. So this is a position that I took and sent out to my Trading Academy students, and there's the screenshot just now. And when I was looking for this short position, I was considering, do I take profits at the first area here, the first area of demand, or could we look to stretch this trade out towards this imbalanced demand as well? Well, this is where the trend liquidity came in, because I saw an area here where we had 1, 2, 3 retests, and below this we would see that there's going to be, within this range, a lot of liquidity. Because by looking at this chart, I can see there's 1, 2, 3 retests of this trend line, which tells me there are going to be buyers on these retest points, which means there's going to be a lot of stop losses and orders situated within this range, sitting beneath these mini swing lows. So knowing that this liquidity and these orders were likely to be filled and traded into, I was confidently able to extend my target down towards the second area. And as you can see, by trusting in that trendline liquidity to be swept, we managed to extend the trade out to over double the size that it would have been. In fact, if I had to target this first demand, it's not a trade I would have taken. But because I understood the trend liquidity was likely to be swept, it became a viable opportunity providing 3.4R, meaning I can take this trade. And I can take it with confidence because I know all the orders waiting under this trend line are very likely to be swept. And the final form of liquidity is the range liquidity. And this is liquidity that formulates around ranges or around swing highs and swing lows. So as you can see, when we look at this market, we can see after it forms a low, we generally are going to get a sweep of that low before the market then makes a meaningful reversal. So just dialing in on this smaller range then, we have a low here. In fact, we have equal lows. The market sweeps these equal lows. Then we have a push up, which sweeps these highs. So we get a sweep of the lows, followed by a reversal, and a sweep of the highs, followed by a reversal to the downside, a sweep of the low here. Then we have a push up, and we sweep the low here. Then, after that sweep, we have a reaction, we sell back down, and we sweep the low down here. Now, all the while, we have larger range liquidity above this swing high as well, which has been swept out too. And of course, that first considered point just down there. So why does this happen? Why is the market constantly pushing for highs and lows? And how do we use this to our advantage? Well, the reason that the market is doing this is simply, as I said before, because the transactions are waiting at swing highs and swing lows. So we know that the buyers here are going to have stops under their swing low. And this would be a lower time frame trend, but it stands true. We know then that any sellers here are going to have stops and orders waiting above the high. Once again, below the next swing low, any buyers that have bought here will have stops there. And above this swing high, or both of these swing highs in this example, there are going to be orders, transactions, liquidity, whatever you want to call it, waiting in that area. So within the ranges, in the middle of the ranges, there's not a whole lot of buying or selling. There's not a whole lot of stop losses, buy stops, and sell stops waiting in the middle of a range. Those orders are going to be waiting at breakout points below or above swing lows and swing highs, which means the market isn't going to reverse too often within a range, not significantly at least. Instead, the market is very likely to trade towards an area of significant orders and then formulate its reaction. This is why we constantly see highs and lows swept out in the market before significant reversals take place. So there's two very simple ways to actually use this to your advantage. Number one is not too exciting, but that is simply to avoid taking positions if you're in a market that is scrambled and doesn't make sense to you. If you're just seeing sweep, 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 and you can't make sense of the market, then don't trade it, because you're likely going to be one of the people getting liquidated by the market movements. So that's the boring but safe way to use range liquidity to avoid taking losing trades. But the other way that we can use range liquidity is to wait for a sweep of the liquidity followed by a change in the trend and then lead into a buy or a sell in line with that, just like we did in the AUD/USD example for equal low or equal high liquidity. So just like equal low and equal high liquidity, swing high and swing low liquidity can be used to formulate reversals for entries and also to be used as very clear targets. Now let's imagine you bought down here. Where would be a safe target? Well, you could simply target the liquidity at the high of the range and you're pretty much locked in with a win, because the market is highly likely to trade freely through the range to tackle liquidity. And in terms of using liquidity for entries, we saw a sweep of liquidity here, followed by a push up in momentum. Then we had a break of structure at this level here. We pulled back down, traded into demand, then we got a push away and traded all the way back up to the highs here. So you could actually take an entire position based purely off liquidity. A liquidation of the low, break in the trend structure. You would then buy from a meaningful point of interest. For me, that's going to be demand zones. And you would target the next point of liquidity, which is going to be this swing high just here. And that would actually lock you in a very simple, safe trade with nothing other than liquidity as the context behind your position. Obviously considering the structure and the supply and demand for entries, but liquidity formulates the entry area, reversal area, and the target area as well. I actually have an entire system built around range liquidity that I've used to take trades like this, and this, and that my students have used as well to take trades like this, and get funded and make money. And because it uses primarily liquidity as its entry context, it's a super simple system to use. So yes, liquidity alone can be incredibly powerful for your trading. Now, if you're interested in learning that strategy, as well as the other systems that I use to trade, then I will walk you through the exact systems that you can use to become a profitable trader, get funded, and start making money from trading. If that sounds good to you, hit the top link in the description and join me inside of the academy. We have a 5-day bootcamp happening too soon, which you can get involved in. If you don't want to do that, that's fine. But I do recommend you continue the learning by watching one of my other videos or check out the links in the description. There's a free course in there that could be useful for you. So thank you for watching this video all the way through to the end. I hope you've enjoyed it. If you have, please drop a like, that helps me out. And make sure you subscribe to the channel so you can get all of my future educational updates. With that said, that's all from me. So I'll see you in the next video.